Good morning. I will call to order the meeting of it's our December 14th meeting of the Oklahoma City Post-Employment Benefits Trust. The first item that we have on is approval of the minutes from the October 12th, 2015 meeting. Could I get a motion? All in favor? Any opposed? Next item is to receive the monthly investment report as of October 31st, 2015 and November 30th, 2015. And the item after that one is presentation of third quarter. And so I'll let Doug take his choice on the order on that, and then we'll come back and approve the items.
It's a perplexing choice. Why don't we start with, let's just go in order of the agenda. So October 31st, if you'll see that in front of you, we have the market environment. For the market environment of October, you can see that it was a nice recovery in the U.S. equity market. If you look at the market update page, looking over at the 1031 column, the Russell 1000 itself, large cap companies, was up over 8% for the month. Russell 2000 small companies up 5.6% for the month of October. And the ACWI ex-US or international equities were up 7.44%. Now what this does not show, or what it takes a little bit to look at here, is August and September were very difficult for equities. You can see losses at the large cap level of 6% and 2.75% for those 2 months. Looking down to fixed income, even some difficulty there, as our markets have been on a risk-on, risk-off pattern recently. If you're looking at the August-September, some big issues going on there were, it will echo what we're talking about this week. Federal Reserve raising U.S. interest rates, and remember they declined to raise interest rates in September when much of the world was expecting them to hike interest rates. We're looking at that happening this Wednesday as well. Most folks, it's almost unanimous that the Federal Reserve will raise short-term interest rates 25 basis points in almost a symbolic increase in interest rates, which is troubling, especially the fixed income markets right now, the short end of the curve. So October results there. You'll see the total fund rate of return for the month of October, just giving you an idea of how volatile performance has been. The total fund was up 5.28% for the month of October. For our asset allocation, that'd be a pretty good year in some cases, and you'll see that the trailing year rate of return there is slightly negative. We're having some issues in our fixed income allocation, which are allocated more to credit rather than government bonds, but we do have a nice diversified portfolio there. I think I'll move into the November report, which you should have with you. I'm assuming we don't have to approve all of these individually. Okay. Now I'll ask you to turn to page 1, which is the market update, and you'll see that November was a pretty good market, but the returns were fairly widely dispersed. You'll see on that far right-hand column on the 2015 monthly market, it's the top table there, highlighting the green area, which is the Russell 2000, up 3.25%, bringing its year-to-date total return to slightly positive, 0.64%. We're looking at the large cap part of the market up 33 basis points, bringing its year-to-date return to 2.77. And as we go down to the ACWI ex-US or international equities, and this includes both developed and emerging markets, down 2% on the month. A lot of that is because the dollar is very strong. We're happy to say that Causeway, our international equity manager, does hedge occasionally, so that protects us from some of the increase in the dollar. When the dollar increases versus the currencies where we're investing in, that hurts us as investors. And then looking at the year-to-date return of negative 3.85%. The aggregate index slightly positive on the year, and the Barclays Global Aggregate, so non-U.S. Fixed income, you can see how it was hurt badly during the month of November, and it's down 7% on the year. We do not have a dedicated international fixed income manager. We figure that our liabilities are defined in U.S. dollars, so we're going to invest in U.S. dollar denominated debt. Looking at performance, it's largely the same picture. So as fixed income, as the credit markets are hurt by some of the liquidity fears going on and generated by the Federal Reserve, you can see that Loomis sales has underperformed fairly dramatically. The portfolio's yield is higher than it's ever been since 2008, 2009, but that does not mean that we are suffering some short-term pain in that portfolio. Double-line bond is the next there. You can see that their recent results, they're slightly below their benchmark for the month, slightly below for the quarter, but looking back over the last 1 year, consistently outperforming, ranking the 5th percentile of their peer universe. That's what the 5 in the parentheses next to that means, which outperformed the index and their median of their peer universe. Our high-yield bond portfolio, which has a limited return history because we've not been invested in it for a full year, it is outperforming its benchmark because very careful credit selection here. But again, high-yield credit is having a tough time in this environment. Hoisington, our long-duration manager, performing as we would expect it to. It's unlike any other manager out there. If we had a 1-year rate of return as of November 30th of 1.15% after a loss of 0.99 for the month, ranking in the 26th percentile. Remember, interest rates will dictate the performance of this portfolio and its investment by the manager. Looking at what 30-year bonds have done recently, I saw as of Friday, the closing yield on a 30-year U.S. Treasury was 2.85%. A week ago, it was well over 3%. So we're seeing big moves. And remember, when interest rates go down, when Hoisington is in their long-duration structure, it helps the portfolio immensely. Looking down for the index fund, the Vanguard 500 index fund is performing as it should. Dreyfus is continuing to be in the same performance pattern that it has been. One thing that is an offset to investing in large global multi-caps is that they're overweight or slightly higher than their index investing in energy because they believe that long-term energy assets are important and will grow. And that's hurt their performance slightly.
Doug, just a real quick question.
Yes.
From our investment committee meeting, we talked about the policy mandating that no more than 30% be invested in one sector. And so do we know if Dreyfus is, since they're heavily invested in energy, if that exceeds the 30%?
That's a great question. And I'm just looking at the benchmark, the S&P 500. It looks to me like the largest sector allocation right now is information technology in the index itself, and it's 20%. Now, looking at Dreyfus appreciation, this is the September 30 report that I'm looking at here, page 23, if you care to flip to it. Their largest allocation is consumer staples, and it's 25%. It looks like the Hotchkiss and Wiley Fund is getting close to 30% in financials. This is our new report, and it's got a lot more detail in it. Sometimes feels like excessive detail, but it is helpful in situations like this. With excessive detail or helpful? And therein lies the rub. Yeah, I'm looking through the other ones. I'm not seeing anyone above 30%. Good question. Thank you for that. Looking at our Vanguard Mid-Cap Fund, it's tracking its benchmark, and it's outperforming many of its peers. Looking at Hotchkiss and Wiley for the month, 20th percentile rank, outperforming its benchmark. For its last quarter, we're below median, slightly have its benchmark. Again, remembering a lot of these portfolios are relatively new, and we're sort of the getting to know them phase and the coalescing of the overall portfolio structure. Looking at Stevens Small Cap, the trend here over the last month and last quarter is improving, and we think that going forward their process should do well because we're entering a more stock selectors environment, and we think that that really helps out for them. And on the following page, Causeway, our international equity portfolio, it is target at 10%, so it is important that we pay attention to it. Its performance, you can see, has been hurt by the rising U.S. dollar. And over the last year, that is the case as well. We've known Causeway for a long period of time. They're excellent stock selectors. Not only do you have exposure to developed markets in this portfolio, but a very, very interesting exposure to emerging markets, which at times will be up to 30% of the portfolio. So if there is an emerging markets recovery, we'll participate nicely in that. So that is the November report. You will also find in front of you our September 30. Again, similar information, much more detail. I think the market environment is now almost 8 pages long to give you a lot of detail. As of September 30 on page 10, you can see that the total fund rate of return is a loss of 3.9%. I'm just going to highlight this unless there are any specific questions. Looking at the total fund value as of September 30, $35.5 million on page 12. A little bit of a plateau here. Market value declines have been difficult. It's been a tough year to be an investor, but again, we take a multi-year view on this. The history of the fund's allocation is on page 13. I like that picture. And then on page 14, showing us where our major allocations are. Equities are our largest allocation. Core fixed income is the next. International equity is almost 10%. And then we have the high-yield fixed income. The Hoisington portfolio, the active duration fits within the core fixed income total aggregate there. Next page shows where our individual underlying portfolios, and as of September 30, our largest allocation was Dreyfus Appreciation. Remember, that is a very conservative, long-term, mega-cap portfolio, very high-quality companies, not always appreciated by the market over the short term, but these are the most stable companies that you could invest in. The next there is the index fund, 500. Then we see our 2 core fixed income portfolios, Stevens small cap growth, our international equity, our mid cap portfolios, and then 2 of our sort of more unusual fixed income portfolios. Cash staying very low at $11,000. This does not include the operational cash assets. So you'll see on page 16 the performance of the underlying managers and the total fund. Talked about the total return. A new display on this report that I very much like is on page 18. The previous page sort of focuses us only on periods ending at the end of the quarter. I like the following page because it shows us that over longer periods of time we've generated double-digit returns in several of the years, a minor loss in 2011. In 2014, we had a positive return. Now, where are we falling short of the index? Part of that is in the equity portfolio because we have very lower risk equity allocation. I'm talking about the Dreyfus Appreciation, et cetera. But then our fixed income portfolio is investing in some more additional credit risk. Now, we don't have returns for many of our portfolios here for 2014 and previous years because we've done so much work to restructure. Hoisington, we have not had for a year. Causeway, we've not had for these previous years. But when we're looking at, say, Stevens, we're looking at Dreyfus Appreciation, not always the prettiest pictures there, but it gives you some idea that on a year-by-year basis, performance does ebb and flow for these underlying managers. And it's not so much their individual performance always, but it's how they fit in with the whole. Now, the following pages give you very, very intense detail of the individual managers, individual portfolios. So page 20 is the index fund. We sort of go large equity to small equity, and then fixed income. Looking at our top 10 securities in that portfolio are Apple, Microsoft, ExxonMobil, Johnson & Johnson, and GE. Following pages are performance details. Page 23 is the Dreyfus Appreciation. You can see a little bit more of the global consumer brands that they're supporting here or they're investing in. So you have Apple, Philip Morris, which is a very stable business that pays off a lot of cash flow. The dividend yield on this portfolio is 2.6%. So just by holding on, you're earning 2.6% per year. And remember, the 30-year Treasury is paying you just 2.9% today per year. Looking at the 5-year earnings growth, 15.22% annualized earnings growth versus 11.79 for the benchmark. The PE ratio is 21, so it's a little bit more expensive. It's much bigger than the benchmark, so you're paying a little bit more, you're being paid more dividends, and you're growing roughly 30% faster than the benchmark. We like those characteristics in the portfolio long term, even if the market's not appreciating it over the short term. That gives you some basis on the performance or the structure of the Dreyfus portfolio. Hotchkiss is starts on page 26, mid-cap equity, investing in a lot of financials, but these are not the big banks. These are insurance companies and smaller regional banks. 62 names in the portfolio, predominantly North America. You can see some invested, less than about 10% in the UK. Those are some companies that are energy companies that are listed in the UK that they're finding attractive right now. And as we look down the names here, not as familiar as the others. Great Plains Energy, that one with the exception, White Mountain Insurance, Aris Group, Conway, and Calpine. Then looking into Vanguard Mid-Cap Index Fund, recall we had when we brought on Hotchkiss and Wiley, we decided to offset them with a passive mid-cap equity vehicle, and it has performed as we would have hoped going away. Hotchkiss and Wiley can have variable performance. This is meant to anchor the mid-cap allocation to look like the benchmark, and then Hotchkiss and Wiley we can have additional patience with them as far as their performance goes. Page 32 is our small cap growth equity portfolio. Remember, this one struggled pretty mightily out of the gate. We think it's starting to improve and prove its mettle here. The top 10 securities here, I'd like to note that not only the names, but the largest position is 2%. And you'll see a lot of 1.7, 1.7, 1.6, 1.6. So they're investing in more companies. There's more risk at the underlying company level here, and they're diversifying that away. PE ratio is very high at 42.8, very high, but that's the type of companies they're investing in. You can see their sector allocations are the blue lines there. Information technology, they're at 24%, but they're not investing in some of the more variable names. Again, they're looking at internet security. If you look at the names here, Icon PLC, Manhattan Associates, Acadia Healthcare, Proofpoint, Parexel. So within the healthcare area, they're not investing in the most go-go biotech stocks, and they're starting to find more attractive companies there. The international equity portfolio starts on page 20 or 35, and looking at the largest names here, they have some cash in the portfolio right now. That's something that Causeway will do from time to time, is to hold cash when they're having difficulty. The cash is denominated and paid interest in U.S. dollars, so it helps hedge the foreign equity exposure as well. Akzo Nobel, KDDI, China Mobile, Sanofi, UBS Group, British American Tobacco, SK Telecom, that's Southern Korea Telecom, and Novartis. Looking at where they're allocated, fairly close to benchmark at Europe ex UK, so that's better than 40% of the portfolio is invested there. The other category, and you see EM Asia, Emerging Markets Asia, at 8%. That's South Korea and China, and you can see that most of that is accounted for by the South Korea Telecom and the China Mobile positions there. Looking at the sector exposures, they are vastly underweight financials versus their benchmark. They are overweight modestly in materials and telecoms. So more conservatively priced companies. Their 5-year EPS is reasonable. Their PE ratio is not that high, and it's yielding 2.96. I spent the last week, ending last Wednesday, interviewing, I think, 13 international equity managers. It is a massively disruptive space right now. We are interviewing both international developed markets managers and emerging markets managers as well. The one thing that I took away from all of those is how difficult an area it is right now, but how cheap some of the underlying companies are. So this is a tough portfolio to look at. All international equity portfolios are tough to look at right now, but I do know that there's significant opportunity out there. It may take a while to realize that opportunity, especially if the Federal Reserve moves forward and raises U.S. interest rates, because that will penalize investors in other countries, especially Europe right now. So tough area to be investing right now, but there's a lot of potential moving forward. Going into the bond portfolios, we're glad we diversified the bond portfolio. It is taking a little while to get this up and running. Double Line has done the best so far. Outspoken manager Jeffrey Gundlach, he is, if you do a Google search for his name right now, you'll find out that he is adamantly opposed to the Federal Reserve raising interest rates. I have to say that I have some agreement with him. He's thinking that they're doing something symbolically, which they should hold off and could have a destructive impact on the market, and he has allocated his portfolio to reflect what might happen. Hoisington, starting on page 40, they will be either hot or cold. They can be cold for several months, but then once you really do need them, once equities do start feeling some pressure, they do very well. If you look at page 41, the bar charts there, and then also the cumulative or comparative performance table at the bottom, they look really good as of September 30, going back for all periods, ranking near, if not above, the top of their peer universe. And again, this portfolio is here to be a backstop. It's here to earn interest, and it's here to hedge away the equity portfolio. So we've been with Hoisington in very difficult markets in the past, and when everything else fails to work, this portfolio has been the one that has hung in, and that's why they're here. Loomis Sales is a credit-intensive manager. This portfolio is managed by three folks, Dan Fuss, Matt Egan, and Elaine Stokes. Dan Fuss has been managing bond portfolios since the 1950s. Currently looking at some underperformance. We're looking at the yield on this portfolio of 4.7%. So you can tell that they are taking credit risk, investing in individual corporate bonds, also investing in some measured exposure to non-U.S. That has hurt performance. This is some of the poorest performance we've seen from Loomis Sales. They are occasionally ahead of the market. They are occasionally positioned opposite of what the market is, and you can see that that has hurt performance recently.
If you look at a longer history on Loomis, because they're just getting beat severely in peer group comparison. So if you look at them longer term, like where you have them in other portfolios, look at them longer term, is their performance closer to the peer group, or do they still fall below? No,
it's top decile. Coming out of the great financial crisis, they were top, first percentile ranked over all of those periods. If you look back at the 10-year result right now, I would say it's no worse than 5th percentile, and possibly in the 1st percentile. So their portfolio is under pressure right now. They've withstood such pressure in the past. Remember, the yield does not go down. The dollar yield does not go down. So the market value of the underlying bonds has gone down, but it's still paying out the same income as it was prior to. So tough environment for an aggressive bond manager. They are investing in high yield. They are investing some non-U.S. They're investing in some preferreds. So we've seen this type of behavior out of this portfolio before. It's uncomfortable, but we know that long-term they're very, very good.
Okay. Thank you.
Our high-yield manager on page 44, remember this one was funded after the beginning of this year, so limited performance, but when you look at fund characteristics on page 44, the 30-day yield on this portfolio is 7.3%. We haven't seen yields on a high-yield bond portfolio above 7% for years. Remember, these are below investment grade, so there is some underlying risk, but defaults in this part of the market still have not risen above 1.5% over the last 5 years. So good income generation from here. The next few pages are more performance, investment growth over the last 5 years and over the last 10 years. No real surprises here. Page 48 is the manager status summary. We maintain all of these ratings. We think that Dreyfus Appreciation is miscast in its peer universe because it does something like no other manager does. They're very much like Hoisington in the fact they invest a certain way that is unpopular with the rest of the world. We think the portfolio has great value in itself and is also very useful as an application here. The next page, on page 49, is a correlation comparison, very small type. I apologize for that. But if we look here, this tells us that our proof statement about the Wasatch Hoisington Fund, number 8, is very uncorrelated with all of the other investments in the portfolio, and that is what we want to see. We have a hedging device in the portfolio. You'll also notice there that double line, when it's indicated red there, that means it has a significant negative correlation with the other assets. So we have 2 that are negatively correlated. The Loomis sales and the Lord Abbott bond portfolios are showing green correlation there because they are invested more in credit, which is a code word for equity markets. Our fee summary is on page 50. Your average expense ratio, dollar weighted, is 0.67. If you did that on a median manager within each of your manager mandates, it would be 93 basis points, so you're saving 25 basis points per over the entire portfolio over a year. So when we're looking at, say, let me see if I can find that. When we're looking at, say, mid-cap is a tiny, tiny universe. I'm not seeing it here. It's comprehensive. I mean, when we're looking at mutual funds, which we are here, it will be comprehensive of several hundred in each group. I can get those figures to you. I thought I might be able to turn to. Yeah, it's not telling me. I can reply back to that because that's important. We want to make sure they're broadly diversified. Page 51. This is a new look on what we've always been looking at, which is our asset allocation, where we show current target, difference, minimum, and maximum. And the table below shows you the ranges for the individual assets in the portfolio. So the Vanguard 500, where it is, the green is in policy. The arrow is actually where we are. The bottom one there, where it shows cash at 0%, it says that it's outside policy. The policy is to maintain very little cash, so anything more than 0 will show up as a out of policy, unfortunately.
And again, that's not our total cash. It's the cash that we count as the invested funds.
This is part of the investment fund and not the operational cash allocation. And that concludes the monthly or the quarterly report, and I'm happy to take any questions about any of the materials presented.
Thank you, Doug. Are there any questions? Thank you very much. Appreciate that. So on the agenda, then, we need to go back and receive. Should I do them? Can I do them as one, receiving October and November?
Move to receive the monthly investment reports for October and November.
All in favor?
Aye.
Any opposed?
Move to receive the third quarter investment report as of December 30th.
I don't think we have to technically receive that one, do we? We do a presentation, so I think we're okay on that one.
Never mind.
Withdrawn, that's right. The next is discussion and consideration of approval of additional asset allocation. I don't think we have any issues there that we need to cover. Item 6 is resolution directing the general manager to give notice of termination to Bank of New York and authorizing general manager to negotiate an agreement with Bank of Oklahoma for custody services. We also do have an alternative option in there to reject the proposals because we only received one proposal and to go out again. We discussed in the investment committee that the investment committee recommended moving forward with negotiations with Bank of Oklahoma, and I would accept a motion on that.
So moved.
All in favor?
Aye.
Any opposed? All right, next item is approval of amendment to the Medicare D Medicare Part D Employer-Only Group Waiver Plan Prescription Services Agreement. It's a mouthful. And it's changing it from Express Scripts Insurance Company to Medco Containment Life Insurance Company. And my understanding, Colin, is that all we're doing is changing the name of the company because of the merger.
That's correct.
Are there any questions?
Move it.
All in favor?
Aye.
Any opposed? All right, thank you very much. Item 8 is acceptance of the interim financial statements, and we have Jake Siebenaler. Did I say it? Siebenaler. I've only known him for a few years, so once, a few years I'll catch up on this and we'll get it right. He's going to make a presentation for us real quickly.
Yes, good morning. We just have a couple areas we'd like to draw your attention to as far as for the first quarter financial statements. If you'll go to page 3 for the management's discussion analysis. Currently, the trust is reporting a net position of $38.05 million. This is an increase of $3 million from the prior fiscal year. That reporting was $35.09 million. So overall, the financial position of the fund has improved over the last fiscal year. For the fiscal year, the trust gained approximately $2.96 million. Of this, $4.22 is from excess employer contributions, along with $631,000 of net assessed revenue offset by $1.74 million loss on investments. And there was an additional decrease of trust administration fees of $145,000. Next, we'd like to go to page 6 of your financials, please. In this section, we're looking at the additions of the reporting at $5.05 million versus $6.73 million in the prior fiscal year. This is mostly due to the investment loss for depreciation and fair value of investments as contributions remain stable. Benefits were $5.92 million, which is an increase of $216,000 as a result of the indemnity plan claims increases. And then finally, we'd like to look at page 11, please. And this is for the asset allocation guidelines. Our asset allocation guidelines, fixed income securities are reporting at 27.6%, leaving a remaining to equities of 72.4%. And if you look back at page 10, our money markets used to pay claims were reported at $3.6 million compared to the prior year of $6.57 million. Do you guys have any questions at this time?
I just had a real quick question. Actually, it's probably more of a statement and maybe a question for Colin Fonda. Where we talk about the increases to the indemnity plan, I'd like to see if those are attributed to an increased number of participants on the indemnity plan as opposed to just a rise in expenses. If the number of participants are increasing, obviously there are going to be increased costs. And so I think I'd like for Colin to take a closer look at that and find out why those increases are occurring.
Sounds great. I'll make sure that we work with him to make sure we get those numbers and information ready for you.
He's got an answer.
Okay, great.
I know the answer because I looked.
Perfect.
This is just a month. This financial is just comparing that month to 12 months ago. Okay. It's just a rise in claims because it's
during that period.
Not a membership. It's just that 12-month period comparing 12 months ago what a difference was. It's not that we have more membership. It's not that we have more activity. It's just that we had a spike or a little bit rise in claims between those 2 months.
Okay.
Yeah, it's not abnormal.
So, so we didn't have a significant number of increase in members or in participants?
It's event-driven.
Okay.
It's claims-driven. The report to really narrow down on is look at a December 31st, compare plan year to plan year, and then you can see enrollment and the activities that way. But
Perfect.
These month-to-months, this is just a spike of the month.
Okay, thank you.
Yeah.
Any further questions?
All right, thank you, Jake.
Thank you.
I'd take a motion to receive the the quarterly financial report through September 30, 2015. All in favor? Any opposed? The next item is to receive the schedule of regular meetings for calendar 2016, and that's in your packets. Any questions? All right, I'd receive a motion on that.
Move it. Second.
All in favor? Any opposed? All right, thank you very much. Fair enough. Yeah, we'll let you be your own judge of whether they're extraordinary or not. I'm not going to put a rating on them. Next item is to ratify the claims listing. Any questions on the claims listing?
Move it.
All in favor? Aye. Any opposed? Are there any other items from any of the trustees or any of the staff? Seeing none, Bob has something. My apologies. Didn't see that hand.
I just want to make a quick comment on the proposal for the custody bank services. They did include authorization for me to terminate the contract with the Bank of New York Mellon. There's a 90-day clause, so we'll go ahead and do that now. Should give us plenty of time to get the new contract in place.
Thank you for that, Bob. All right, then we are adjourned.